super nice to meet all of you, and thank you IFA Galaxy for inviting me. It's always special to do something in Chennai. Yeah, so I've been given a very interesting topic, which is portfolio construction framework for MFDs. Now, this is not specific to MFDs. This is a broad approach that anybody can follow. Now, the moment you find a name like portfolio construction framework, it looks a little theoretical. So what I mean, all of us are practitioners. So instead of taking a very theoretical approach of this is the framework and all that, I'm trying to make it a little more practical, where probably we'll start with a simple use case that, hey, there is a young guy who's wanting to invest a particular amount. He has his fairly long time frame, say 20 years, and he can take a lot of risk. Broadly, he says that I want to build wealth over long periods of time, and I want to get as high returns as possible. This is a very simple use case, and let's see how we kind of go about thinking through this. So broadly, I have four levers that I generally use to build portfolios. The first lever, I call it the ABCD levers. The first is a simple thing, asset allocation. How do you put together different assets? The second is within assets, how do you balance the portfolios? The third is how do you choose the right funds, PMS, whatever, right products for that. The last part is delta opportunities, where are there tactical or are there opportunities where you can take slightly higher risk, but with the attempt of giving you slightly higher returns. So, and obviously, once you get the four in place, you look to make sure that you're not paying excess tax or excess cost, and it's a fairly liquid portfolio. Finally, you optimize for that. And obviously, you have a lump sum and SIP getting into this. So you'll also have to build a framework on how to invest your lump sum and how to do your SIP. So I'll be broadly covering these four. So let's see how this goes. First is very simple, that the intuitive thing is probably I'll go for 100% equity. But I mean, I have a tool where broadly you can plug in different allocations for equity, debt, gold in Indian context, and you get different numbers. So broadly, I've seen that equity at 70%, debt at 15%, and gold at 15% is almost like a sweet spot, like equity around 70% plus or minus, say 10%. Generally, historically, at least from an Indian context, has given you returns which is very, very close to a pure equity portfolio. You can see the bottom part showing almost 13% in pure Indian equities, which is the Nifty 50. And you can see that this combo, which kind of you rebalance every year for a 5% deviation, is all, I mean, right now it's beating it, but for all practical purposes, it's more or less come very, very close to the pure equity allocation. So this is the first thing. Now, obviously, right now, gold has done extremely well in the last 3 years. So whenever you do this static point-to-point allocations, there's a good chance that we may get a little swayed. So the better way to look at it is in terms of 7-year rolling returns. So even there, if you look at it, the average returns for our combo, which is equity 70, debt 15, gold 15, is almost 15.1, which is almost exactly the same as the pure equity allocation. But the better part is you look at the range, right? The 7-year range has been between 7% CAGR to 28%. And again, for pure equities, it's between 5 to 30%. So broadly, it's almost the same. And the other way to look at it is that what's the odds of making more than 10%? It's 91% for the combo versus 83% for pure equities. And even more than 15%, it's almost 38% for the combo and 37% for us. So net, what this shows us is that if you take a slightly longer time frame, say a 7-10 year cycle, while you have a much lower equity allocation, you're still almost able to get equity-like returns. So this is, and now the question is, why should we do this, right? Now, while obviously you can make returns very similar to equity, the real reason is that it makes our client's journey a lot more palatable, because you can see the critical difference is that a pure equity fell almost close to 60% in the last 20 years, which was the worst fall was in 2008. Whereas the worst fall here is around 40%. Now you might ask, hey, down 40%, down 60%, it's only 20% different. Is that a big number? It is a big number because this 20 is almost equivalent to 80%. I'll explain why. Because from 100 to 60, and then back to from 60 to 100 is almost like a 70% upside required. Whereas that 100 rupees goes to 40, and then goes back to 100, it's almost like 150% upside required. So on the upside, if you look at it, it's almost like a 80% difference. So this difference in reducing the downside that you're getting is very, very meaningful. So which means that a good starting point for this client probably would be that, okay, let's have this equity 70, debt 15, gold 15, and we'll kind of rebalance for a plus or minus 5% deviation every year. Now, ideally, you can stop at this. This is good enough. But unfortunately, people like me unnecessarily complicate it. So we say, oh, hey, how do I improve this further? And then I add two more clauses. The broad assumption being 80% of the times markets are probably slightly expensive or neutral or slightly cheap. But broadly, they are in a normal range, which is okay, where your asset allocation solution that you did in the first level works perfectly. But then you also know that there are times when it goes very extreme on either the pendulum swings either to a very, very expensive zone or very, very cheap zone. And the question is, can we kind of try to exploit these extremes, right? And that's when at an extreme on the higher side, like it becomes very expensive, then it's a bubble. So you think about what you do during a bubble. Then if it becomes very, very cheap, let's say there's a 50% correction or a 40% correction, how do you exploit that? So that becomes the crisis plan. So overall, it becomes ABC, which is asset allocation, bubble plan, and crisis. Now, crisis is a simpler thing. Historically, if you look at it, Indian markets generally every decade kind of has fallen 30 to 60%. Again, we saw a COVID fall of close to 40. Last decade was pretty peaceful at least. But again, 2008 was a 60% fall. Now, I have no idea whether when it will happen, but it's reasonable to expect that at some point in time, again, we'll get a very large fall. The approach is very simple, that every time it fell 30%, there are 7 times in the history. Historically, every time in the next 2-3 years, you ended up almost 6 out of 7 times, you ended up making very, very decent returns because the market inevitably recovered. Same thing for 40, there were 5 times, and all the 5 times you made more than 20% had you invested at these 40% levels. And same thing at 50, it was even more crazy if you are invested. So the broad thing is that, hey, if the market is falling at 30, 40, 50%, while when you are in it, it looks very scary. But always in hindsight, it looks like, hey, I should have invested. So can we do something around it? Can we pre-build some rules so that we don't panic at that point in time? So this is a simple concept called overbalancing, which is nothing but rebalancing is what, let's say the same 70% equity, if it comes down, I bring it back to 70. But here the question is, okay, at 20% fall, I bring it back to 70, that's fine. But let's say if we get a 30% fall, which is Sensex currently, let's say for some reason something happens and it goes to 60,000. Should I bring it back to 70 or can I go a little higher and then make it to 75? And then at the next level, at a 40% fall, I make it to 85%. And then at a 50% fall, I make it to entire 100%. Now, this is completely up to you. You can say, hey, I don't want to do all this. I will still stick to 70. Somebody might say at max, I might go to 80. Somebody might say at max, I might go to 90. So this is completely flexible, but you can fix this plan. Now, this is a rough plan. There's no sanctity there's no hard and fast rules. But something around this, if you can think around it, then managing this more than the potential for higher returns, behaviorally, it's a great tool because when there is a lot of uncertainty combined with lack of control, like what should I do, losing that sense of control, it's a very dangerous thing and it's extremely stressful. So in this time, while obviously there is a lot of uncertainty, at least there's a sense of control that you are doing something around it and it's already pre-planned. So something around this can be a part of your crisis plan. Bubble, again, a lot of people keep calling for bubble because they generally fall into something called the single indicator fallacy. There'll be somebody saying, hey, this market cap to GDP is so and so, it's a bubble. But generally it's a problem that you go with one single indicator. Mostly you'll be calling for a bubble almost every 2-3 months. So the ideal way to do it is just like how 5 blind men touch elephant at different points and conclude a different thing. It's to come back, put all the points together and then get a better framework. So what I personally do is I look at 5 things: valuations, earning cycle, demand versus supply, which is who's buying and who's selling, and the sentiments, and then you look for triggers. Generally, triggers comes through politically. There is some uncertainty, there's weak macro, or there is leverage somewhere in the system, or there is an unpredictable crisis. Unpredictable, obviously, you can't do anything. But all the others can be broadly tracked. Now, right now, I don't want to get into this, but the broad sense is that right now there doesn't seem to be any signs of bubble. But you can build a framework like this so that each and every time there is somebody warning you of a bubble, you can figure out what are those indicators and you can plug and play. And nowadays, most AMCs publish a lot of these monthly reports. And if you collect 4 or 5 of them, you will more or less get all of these data. It's just that once you put them together in this format, it becomes easier for you to decide. Same thing, we have something similar for gold, where we look at demand, you look at gold versus inflation, you look at gold versus US real yields, you look at gold versus cost of mining, you look at gold versus money supply in US, and you compare it with the Indian equities. Right now, the framework for us is showing that it's very, very expensive. It's almost at an extreme. But broadly, some frameworks like this can be built, but with the key intent that if required, you can go slightly underweight on either equities or gold if it gets into an extreme. Again, this is purely optional. You can say 0%, I will never go underweight, because you can also think about it like 70% is by default an underweight, because from 100 you're already at 70. So there's no harm in it. But the idea is it's good to start thinking about it, because otherwise in the middle of a crazy bubble, you don't want to change your strategy. So in good times like these, it's a lot easier to put all these things together. So overall, looks very complex, but if you put it together, it just comes under a 6-digit number called ABC portfolio code, where AA will represent your equity allocation at 70%. BB is in a bubble, what do? Do you go underweight by 10%, 20% or 0%? Now, if you say I will never go underweight, you make it 0-0. And then at a crisis, instead of 70, I will go up by say 20, 30%. Then you put the CC number as say 30%. So for each client, you can have a different number of, around this, so that each and every time you don't need to think through this. A simple example would be something like this. The same thing for the client might be 70, 20, 30. So which means normally I will be 70% equity and the remaining 30% split between debt and gold. But in a crisis, I will move the entire 30% into equity, because as per my plan, I have told it's 30. Now in a bubble, I will put the second part, which is B will be 20%. So instead of 70, I will move 20% out of my equity and probably move it into a DAF or a BAF. And maybe if you want to go even more conservative, either a debt fund or a gold fund, that's completely up to you. But this is a simple way in which, so putting it together, mostly you can stick with asset allocation and let it run. But if you want to complicate it like me, you add the bubble part and the crisis part. But it gives you a lot more control over the portfolios. And let's look at how it falls, right? So right now we've decided that we'll go with the 70, 15, 15. And probably gold looks very expensive. So I go down underweight by 10% and make it 5. And that remaining I moved into debt temporarily. So that becomes 25. So this is how I start with the asset allocation. And the next question that we are trying to address is, how do we build portfolios within equity, debt, and gold? Simplest is gold. You either do gold ETF or gold index funds. And debt also, I don't complicate it much. I do a very simple, short duration, high credit quality, because the primary reason why I don't take credit is that for us, the debt portion is something that we will have to move into equity at some point in time. Now, when you take credit, the big problem is that when there is a crisis in equity, you also have a problem in equity, which is down 40%, and you also have a problem in your debt, which is in credit. So you will get double whammied. And then again, credit funds are illiquid by nature. So by default, to run a good credit fund, you will have to get into an illiquid or a closed-ended category. If you do an open-ended category, we all know the risk that we saw a few years back, right? So net, my sense is debt also, I keep it really simple. Probably pick a tax-efficient category, like say income plus arbitrage fund or something. So all we need to solve for is on the equity side. See, this is a nice chart which is published by MOSL Alpha Strategies, where basically it says what happens to the top 25 funds in the next 3 years. So you can see that the number one fund between 2019 to 21, after which you would have bought it, became the 225th fund. And then again, the second fund became the 200. So broadly, you can see that this is a trend that continues across cycles, that some fund which is doing phenomenally well today, suddenly in the next 3 years again goes back into the bottom, and something which was not doing well suddenly comes into the top. Now, why does this happen? Very simple, that there are different investment styles, and these investment styles keep rotating. You can see value was doing badly between 18, 19, 20, and then 21, 22, 23, and almost in the last 4-5 years, it's done extremely well. So if somebody had looked at only performance and bought, they would have bought into quality-oriented funds and for quality to come down into the bottom. So the key crux is that different fund managers will have different biases towards a particular approach. And all these approaches, unfortunately, won't work in all the short-term periods. They will have a rotation that we see. But the good part, or how to start thinking about it, is very simple. That in the longer run, if you look at different styles, say quality, value, size, momentum, all the styles, almost in the last 20 years have given 17 times to 20 times. Vis-a-vis your plain vanilla index, which is roughly close to 10, 11 times. So which means that you pick any of these styles, and if you are able to hold on for a long period of time, you're kind of sorted. And also, if you look at it on a 7-year basis, most of these styles have consistently outperformed the broader benchmark. So which means, what is the whole thing? You just need to figure out one fund manager who's following a particular style. And then if you hang on with him, you will be through. But since it's very difficult, the idea is, can you pick 4 or 5 different investment approaches, put them together, so that each and every year where 1 or 2 fund managers are not doing well, the other 3 kind of get to rescue us. So this was a broad concept that we had, at least in my earlier firm, Funds India, this was the broad concept that we had way back in 2020. And we put together something called the 5-finger strategy, where we combined 5 styles like growth, momentum. At that point in time, it was global because momentum was not there. But now that we have momentum, we combine these 5 styles: growth, momentum, value, quality, and mid and small. And let's look at what happened. Obviously, 2020 was a back-tested thing. It was great. Generally, backtest doesn't work. But thankfully for us, it worked even after that. So you can see from 2020, when we started, it's almost giving us 19% return, which is a 5-3% alpha vis-a-vis Nifty 50 and Nifty 500. And the performance has been fairly consistent. If you look at the 5-year rolling, it's been fairly consistent. And here is the main chart which I want all of us to focus on. It's not about the performance. It's not about what styles we took. The key thing to notice here is that if you look at value, right, I got the maximum scoldings for having that fund in 2020 because for 4 consistent years, it had underperformed the benchmark. So all these numbers are the underperformance versus the Nifty 500. And so you can see that each and every year for 4 years, so it was almost impossible to buy that fund. But because of this structure, we forcefully bought that. And the next 5 years, that fund kind of rescued us. And at that point in time, quality was doing extremely well. In fact, that particular AMC got the amount of money that they collected was more than the entire industry put together. It was that crazy. And you look at what happened in the next 5 years. But the point is, we still have it. Because at some point in time, when it turns, I'll be the only guy who still has that quality fund, right? But the key point is, if you look at the bottom line, which is actually the year-wise outperformance, you can see suddenly how consistent it becomes. But the key is, every year, it's not the same fund which is rescuing me. It's some fund or the other, and they keep rotating. So what happens is that while internally funds keep fighting amongst who is the winner, for me, it gives me a much better experience for our clients as well. So this is something that I think all of you can take back home. That not about which style, identify approaches which you think can work over long periods of time and make them very different, and then put them 4 or 5 of them together and then let them run. You'll have a very, very interesting experience like what you saw here. And the best part is that the valuation, the downside has also been much lower. So putting it together, equity, you put 5 domestic styles, add 1 global, debt, I told income plus arbitrage, and then gold you use via gold index funds. So suddenly you fill them up, 80% of equity goes into domestic core, and then you add another 20% through global. So broadly, this becomes the structure. Now the last part is, how do I pick funds? Today, unfortunately, I don't have time for this, so I'll skip this part. We come to the 4th, delta opportunities. Till now, it's like, I don't know much, whatever be the environment, this strategy will do well. It's more like a humility-driven strategy. But all of us have our experts inside, so which wants to look out for delta opportunity, where we want to do some tactical bets. So here, the broad idea would be to bucket them into styles, sectors, small caps, global, and see for extreme underperformance with extreme undervaluation, and the fact that they are unloved and there is a bad story going around it. Generally, some of the patterns that I've seen is a good fund manager who's underperforming for 3-5 years is usually a good fund that you can use for further analysis. See, all these are initial alerts that you need to probably pick them and analyze them further. And probably a fund which is underperforming but still has low churn over the last 4 or 5 years. And if you plot the valuations for different funds, again, you will get funds which are extremely low valued from a PE, PB. Sometimes they might also become very attractive. So you can do different formats for sectors and themes. Again, a lot of AMCs are launching sector rotation funds. You can just check what are the sectors that they are liking, and then you also do your own analysis that, so there are different ways to build the cat, but if you can do it on a monthly basis, this can throw up a lot of interesting opportunities to give that extra kicker. So you can add that as another 20%. So earlier we only had core part. Now we can add the delta portion as well. So the rough split can be 60% into core 5 styles for domestic equities. Another 20% goes into global, and another 20% goes into the equity delta risk. And this again, I'm debating in my mind whether I should keep it inside the portfolio or keep it outside. That maybe in some time I'll also get to know that. But right now I've kept it inside. And the last part is this. This is how you construct the portfolio. But the real challenge is how do you stick to it? I think whatever happens, whatever portfolios that we built, our clients will have to handle these 10 things, which is the markets will try to do 4 S's, which is it'll try to scare us and our clients. It'll try to slow us, it'll try to trigger a switch within the portfolio, and it'll also try to seduce into newer products. So generally the scaring part will get done through all-time highs, some bad news, some crash prediction by somebody. There'll be a decline which will always be like this 10-15%, is it the start of a 50% fall? Then every time you enter, you will always feel that it'll go down 10% and I'll wait for that. Then you will want to switch immediately, your fund underperforms. Then there is boredom. Then you will want to chase something which is doing extremely well. Then there is always some new product, fancy product coming in that gets you distracted. And then your friend's portfolio is always doing better. So all this put together does the 4S. So summing it up, very simple. Build a strong foundation in terms of an asset allocation. Do an annual rebalance for plus or minus 5%. This should be more than enough. If you're a little adventurous, build a bubble plan, build a crisis plan. Put them together as a portfolio ABC code. And then within equities, diversify across different investment styles, which is probably the most important thing. And try to look out for opportunistic allocation, primarily through contrarian opportunities. The last part is control behavior. Obviously, I couldn't touch upon it today. It's a separate 1.5 hour presentation. So once you put together all these 5, you get a good portfolio and a good long-term return experience. Yeah, thank you so much.